Welcome to the International Accounting Channel. First time joining the program, remember to subscribe to the channel, like, share with everyone. Today we share with you the lesson on periodic inventory system. Now, let's get started. Under periodic inventory system, inventory account is not updated for each purchase and each sale. All purchases are debited to purchases account. At the end of the period, the total in purchases account is added to the beginning balance of the inventory to compute cost of available for sale. The ending inventory is determined at the end of the period by a physical count and subtracted from the cost of goods available for sale to compute the cost of goods sold. The general formula to compute cost of goods sold under periodic inventory system is given below. Cost of goods sold, COGS, equals beginning inventory plus purchases minus closing inventory. Journal entries in a periodic inventory system. When goods are purchased from supplier, debit purchases, credit accounts payable. When expenses are incurred to obtain goods for sale, freight in, insurance, etc. Debit freight in, insurance, credit cash, bank account. When goods are returned to supplier, debit accounts payable, credit purchases returns. When payment is made to supplier, debit accounts payable, credit cash, bank. When goods are sold to customers, debit accounts receivable, credit sales. When goods are returned by customers, debit sales returns, credit accounts receivable. When cash is collected from customers, debit cash, credit accounts receivable. At the end of the period, debit inventory, ending cost of gold sold. Credit purchases, inventory, beginning inventory. Advantages of a periodic inventory system. 1. Simple and cheap to implement. A periodic inventory system is both simple and cost-effective to implement. You don't need to invest in inventory software because inventory counts are done manually once or only a few times a year. 2. Ease of record keeping. With a periodic inventory system, you can easily manage your records using either a physical or computer based spreadsheet. The three basic parameters of periodic inventory are the current quantity of items in stock, the number of items purchased, and the number of items sold. Recording these three items on your spreadsheet makes it easy to analyze the data and make any necessary adjustments. 3. Ideal for smaller businesses. A periodic inventory system can be used by businesses of any size. However, it is ideal for small businesses with specific inventory types or low inventory levels where sales and costs are easier to control. For larger organizations, inventory tends to become more complicated as they deal with higher inventory transactions and thousands of orders per inventory period. 4. No disruption to normal operations. Your physical inventory counts can be scheduled at any time, meaning they can be conducted outside of normal business hours and at very minimal cost to the business. However, physical inventory counts can also be outsourced to a third party that offers full stock-taking services for businesses of any type or size. Disadvantages of a periodic inventory system. 1. Increased risk of human error. A periodic inventory system has the potential to be highly inaccurate. This is because your accounting records are only modified at the end of your year, or the end of a pre-established accounting period, to reflect your physical inventory count. While it's possible to ensure a reasonable degree of accuracy, you'll never be completely sure of your inventory accuracy between physical inventory counts. Manual counts are also susceptible to human error. Common errors made during physical inventory counts include inaccurate counting, incorrect calculations, and inventory misrepresentation, or the data entered incorrectly into your spreadsheets. 2. Labor-intensive. The periodic inventory system is challenging if you have limited inventory. With low levels of transactions throughout the year, it's easy to update inventory data in a manual system. However, a periodic inventory system can prove to become highly challenging as your business grows. Physical inventory counts are more labor-intensive. The bigger your business becomes, particularly if you have large amounts of inventory transactions. 3. No real-time visibility. Businesses need to know what's selling and what isn't. Without real-time inventory information or gross profit data, it is difficult to optimize operations for greater business success. And without significant inventory data, you're at risk of costly stockouts or, conversely, expensive inventory holding costs. 4. Tough to maintain control. It's difficult to maintain control of inventory or identify losses using the periodic inventory system. Since your inventory is only being counted at specific times, it's impossible to navigate instances of theft, especially if inventory counts are only done once a year. Thank you for watching our channel. See you again in the next video.